All right, I think we have to start with the NASDAQ. Under a lot of pressure this morning on the back of the Meta report, citing some weakness in ad spending due to the Israel-Hamas war right now. What's your take when it comes to mega-cap tech and the impact on the broader market?
Yeah, I think your first guest, Arjun Kapal, said it perfectly, which he said there's no room for error. And so what I've been thinking about a lot is stocks with room for error versus stocks with no room for error. And that's really, I think, the problem with these mega cap companies, because the numbers they're reporting are spectacular. But when you're up 150%, or when you're trading at 30 times earnings, there's no room for error. So I've been thinking that whole no room for error, it's not just valuation. It's either how much the stock has run up in anticipation of these great numbers or what the valuation is. And so I think there's just too much, there's been too much hope in them all year.
Well, Jenny, as you know, this is the busiest day of the earnings season. With that in mind, what's your WEX word of the day?
Yeah. Inflection. And it goes straight back to that. I think that we're at an inflection point in terms of market leadership. And then actually Guy said something about this too, where he was talking about Amazon's valuation and Amazon's results, and he was saying something about November 2020. And I look back to that November, September 2020 and think about how that was also an inflection point for the market leadership, and it was pretty significant. So from the fall of 2020 until SVB this year, those big guys lost their leadership. They still did well, but they weren't the leaders, and I think that we're at another one of these inflection points right now. All
right, so I know you own Meta. We also saw Alphabet report, and we have Amazon coming up. What we saw from Meta and Alphabet, how does that make you think about this Amazon report after the bell?
It makes me nervous for Amazon.
Oh, really?
Because I just don't know, again, when they're up this much, like, what can you do? I was trying to explain this to my daughter last night, and it's really hard, to say, okay, but they just had revenues up 34% and the stock's down 3%. That doesn't make sense to the average mind. But it's all that anticipation, and there's just too much in the mega caps. I mean, what are they up, Frank? Like 55% collectively year to date or something? They're 50+% of the S&P's total return. They're all trading at valuations that are, I think, 6 multiple points or more, maybe closer to 10 multiple points ahead of the other 493 stocks in the market.
Okay.
There's a disconnect in valuation.
All right, I want to get to our mystery chart. It's one of your picks of the day. We're talking about Verizon. Just came off earnings a few days ago. What has you liking this stock right now, also in a higher rate environment?
Yeah, there's so much room for error, right? They've got an 8% dividend yield. They're trading at 7 times earnings. They were up 9% after their earnings call. And all they did was say, like, oh, hey, we're going to raise free cash flow guidance a little bit. We're going to lower CapEx a little bit. And the consumer's still competitive, but not quite as bad. You know what their earnings are going to grow at? I don't know, maybe 2% a year for the next couple of years. Their dividend is going to grow also at about 2% a year for the next few years. When you can say that and see your share price go up 9% because there's so little expectation for anything, I think this is where you want to be right now.
All right, so one other name I want to talk to you about, American Express. That's your other pick. We're seeing a slowdown in consumer spending, and you're saying now's the time to buy this stock?
Yes, and very specifically, because what's interesting is if you look at American Express and what they reported versus, say, Discover Financial, what you see there is both stocks over the past few months are down about the same. They're down about 17 and 20%. But meanwhile, American Express is only seeing 1.2% of credit card loans in excess of 30 days. You're seeing Discover at like 3.4% of loans in excess of 30 days. You've got American Express trading at 12 times earnings, and they're guiding for double-digit, actually like mid-teens earnings growth through 2024 and beyond. So what you have here is that over-concern, that intense concern about the consumer pressuring all stocks in the same way, when actually you need to start to sort through and say, hey, some of these are different and some of these service a higher consumer.